Welcome to Financial Accounting. We're going to tackle some transactions from a merchandiser's perspective. All of the transactions in this demo are going to be on sales. Here are the transactions that we're going to handle. We're going to do these one at a time, but we are a company called 26.2, and we're going to sell goods to a couple of individuals with some different scenarios and different terms. Okay, the first example we have is on January 4th. We sold merchandise for $12,000 that cost us $6,000. We did this on account. The terms were credit, net 30. That's what N30 means. You have to pay the full bill in 30 days. So on January 4th, we're going to simply debit accounts receivable for $12,000, and we're going to credit sales revenue for $12,000. We also need to update the cost of goods sold account, which is an expense account. So we're going to debit it for $6,000. That increases the expense account. We're also going to reduce our merchandise inventory by the inventory that's sold, thus going out and needing to be decreased on our books. The next entry on January 8th, the sale we just made, $400 of those goods were deemed to be unacceptable, so our buyer returned them to us. So the way we record that is we're going to debit the liability account refunds payable, and we're going to also reduce the accounts receivable because we're no longer going to receive $400 worth of those goods. Now I know that seems really strange to be debiting a liability account because we've probably never done that before, but this is where it comes from. So let's say we have done the adjusting entry on year end, the year prior, December 31st. And let's just say, we're just making up these numbers and pretending that we estimated returns to be 4% of total sales, and total sales were $1 million, and those goods cost us $600. So what we're going to do that year-end adjusting entry is we're going to debit sales revenue. That reduces our sales revenue account by the amount we expect to be returned, which is $40,000. That's 4% of $1 million. And we're going to set up this liability account called refunds payable. And these are the refunds that we expect to have to process for our customers. Now next we're going to debit estimated returns inventory. This is an asset account, and it's just an estimate. It's something that we set up that we are expecting. And then we're going to also reduce cost of goods sold by those returns that we expect to get at cost. And where we got the $24,000 was just 4% of $600,000. So again, this is hypothetically what we probably adjusted the year before, but I just wanted you to get familiar with the accounts. That's why when we actually process the refund, we're debiting refunds payable because we credited it here to establish it, and we're reducing it here when we actually pay out or process the refund. Now the other part of that refund entry is going to be to debit merchandise inventory because inventory is coming back to us if someone's returning it, so we need to increase it by $200. And we also need to reduce the estimated returns inventory account. So we're moving it out of an asset account, estimated returns inventory, and into the actual merchandise inventory because that's what it is. Next, on January 13th, we received payment from the customer less the return. So the original purchase was for $12,000 and they returned $400 of that. So our entry is going to be for $11,600, and we're going to debit cash because that's what they're paying us, and we're going to reduce their accounts receivable by the same amount. The next entry we have is on January 20th. We sold some more goods, but this time we have credit terms that offer a discount. The 2-10, N45 means we will give them a 2% discount if they pay within 10 days, but they have to pay the full amount in 40 days. That's what N45 means. It's net 45. FOB destination tells us about the freight. What that says is whose merchandise is it when it's in transit. If it's FOB destination, it remains the seller's inventory until it gets to its final destination, and then it becomes the buyer. So while it was on the plane, the train, whatever carrier we used, it's going to belong to the seller. And we are the seller in this example, so we're going to be paying the freight. So that's just something to keep in mind. The cost of these goods sold was $31.50. Now our new revenue recognition standards state that we have to record the sales if we offer a discount at the net amount. So we're going to factor in on the front end and assume that everyone's going to take the discount. And if they don't, we'll handle that later. So what we're going to do is we're going to debit accounts receivable for the net amount, which is 98% of 6,300. So you can do this in 2 steps like they've done here, but it's much easier to say, okay, if we're going to give them a 2% discount, we're not going to receive 100% of the money, but we're going to receive 98%. So that makes it a little easier and takes out a step. Then we're going to credit sales revenue for the same amount, 6174. Now we have to take care of the cost. We're going to debit the expense account cost of goods sold for 3150, and we're going to reduce merchandise inventory because we sold it. It's going away, so we're going to credit it for 3150 as well. Next, it says we paid $270 on freight. Now, I don't want you to get confused about freight because sometimes when we're dealing with freight, we debit merchandise inventory, and sometimes we're going to debit an expense account. Now, this is very simple. It just depends on who you are. Are you the buyer or are you the seller? Is this freight in or freight out? So if you're the buyer, which we are not in this example, if you are the buyer and you're paying for freight to come into you, think about the word in. Freight in is an inventoriable cost. So if it's inventoriable cost, we would add it to merchandise inventory. So we would debit merchandise inventory. But this is freight out. We're the seller and we're paying for freight to leave our warehouse and go to the buyer's destination. So this is a delivery expense. It's a normal everyday expense of us doing business. It's a shipping cost. So we're going to debit delivery expense for $200 and we're going to credit cash for $270 is what I meant. On January 29th, we received the payment from the customer on the amount and it's less the discount. Notice that the sale originally was on January 20th and they're paying today on January 29th. So they're within their 10-day prompt payment period. So we're going to debit cash for $61.74 and get their accounts receivable off of our books with a credit of $61.74. Now, I know what you're probably thinking. What happens if they did not pay within that 10-day window? Well, this is what happens. If they didn't pay, let's say they waited till January 31st to pay. So we're going to debit cash for the full amount of the invoice, which was $6,300. We're going to still have to get rid of the accounts receivable for what's in it. Now, all that was in it was $61.74 because remember we netted out that discount to begin with. But since they didn't pay on time, we're out of balance here. So we're out of balance by $126. And what we're going to credit then is sales discounts forfeited. And that puts us in balance and everything's good. I hope you enjoyed this demo today. This was Perpetual Sales.